We've been holding out quite okay. Yesterday too, we nicely climbed above the 24,400 print, while yesterday, of course, the baton was led by autos, clearly led, of course, by Maruti, but across the sector, you did see a fair amount of move coming in. But that aside, just let's step back and talk about how the global markets have been panning out vis-a-vis our markets. And that, of course, is a stack up of the kind of foreign flows that one has seen year to date. While it's a dip down for China and Thailand, India is just about holding its head above water. And yes, markets like Taiwan as well as South Korea have seen the bigger amount of inflows. Having said that, regardless of that, our markets continue to hold out at their all-time highs. And that, of course, is a stack up of how the global markets have panned out throughout this year. It has been, the biggest move for the tech-heavy Nasdaq. You've got the S&P 500 out there and the Nifty 50 right on top with those, indexes with a 12.5% move coming in this year so far. So we've done quite okay for ourselves. Of course, the gains are, much more exaggerated when it comes to the SMIDs. That's the mid and the small caps.
So global strength, flows, and desperation that you're not in the market. These three factors are at play. So between 1 week ago versus now, in terms of the news flow, in terms of the positioning, in terms of a global update, in terms of a local news flow, very little has changed. But the market orientation is clearly centered around global strength, flows, and also budget. So these are three things which are driving the market, and I think they will continue to drive the market. If one works with an assumption that global markets will be strong, nothing untoward will happen in the global market, flows which are reasonable right now, and the budget is something where you would see new ideas, more push, more focus on growth. So that in a sense will continue to drive the market momentum. So if you are in this market, while it's very easy to take a call based on the recent run up that markets are looking expensive, markets are looking stretched, it's time to just sit on cash, that may not be a great strategy. Very rarely you see this kind of a vertical move, both locally and globally, which is supported by flows. And when you see a combination of global strength, global flows, and local participation, the best way is to stay with the market. This is not the time when you say, okay, I'm going to go against the market, which is I will raise a lot of cash, or I will, go short in the market. So just stick with the trend. Trend, like they say, is your friend. And the trend right now in the run up to the budget, at least in my book, looks quite reasonably bullish.
Yeah, I can safely say that, especially after mapping out yesterday's price action too, the fact that we gained close to 0.5%, you had the frontliners as well as the broader markets comfortably in the green. As Aisha also flagged off, FIIs continue to remain buyers. So fifth straight day on the trot that you had the FIIs which continue to pour in money. And it was the longest FII streak, incidentally, that we've seen in the last 4 months, which is quite encouraging, though of course FII flows alone is not going to prop up the market. But of course, the notable outperformer yesterday, without a doubt, was Maruti Suzuki, top gainer on the Nifty, nearly a 7% gain, and that too at close. And we had the news that the UP has freed the hybrid vehicles from registration by waiving off that 100% road tax, and that sent the stock to its biggest gain in the last 2 years. Volumes as well, nearly 3 times the last 20-day average. Nikunj.
Yeah, if you frankly ask me, that's a surprise move by the stock. While you can assume that what's happened in the state of Uttar Pradesh will be followed by other states also, and this is something which in a sense is going to be a big positive for the Maruti stock. But yesterday's price act, more than yesterday's price action, I think the volume action is something which in a sense was quite extraordinary. So that is the frame of the market we are in. While we'll talk about extensively in terms of Maruti, and there's a news which has come on the CNG price cut also, which in a sense would give a fillip to the Maruti stock further. But this is the frame of the market we are in, which is that where good news is getting disproportionately rewarded, bad news is getting just ignored completely. So we are in that frame of the market where markets right now need to, they're just reacting to this particular news. Now for Maruti per se, if you analyze the news in isolation, it's going to move the needle, but it's going to move the needle in a very gradual manner if one assumes that what UP has done, other states would also do that. So incrementally nothing will change in this quarter, or frankly very little will change in this financial year also. But incrementally this means that the push towards new sources of energy is something which both the central government and the state government would like to drive. And for Maruti, since this is the first time something has come on the hybrid category, which is where the market leader are, it just gives a indication that how the new car transport stroke new source of energy would be promoted.
The Nifty implied open just about flitting between the green and the red around the 24,480 mark. But of course, the big events that the market has on its mind is the union budget, of course. And then you've also got the Q1 earnings, and stepping into the earnings season, perhaps from the fact that we had a high base last time around, Nikunj, we could see a bit of a decline in the earnings growth for Q1.
It's a good report from Morgan Stanley, Avan, because now from next week we would essentially move into what could be called as the earning season. And since the base this time is high, the difference between the Q4 versus Q1 earnings season is directionally you will grow, but in terms of pace of expansion, because of high base, Morgan Stanley feels that the contraction actually could be there. So it's going to be on absolute basis, it's going to be strong, but on relative basis, if you compare with the last quarter, the base effect should kick in. And then there, of course, would be this whole impact of election spending and, summer and heat wave, which in a sense could have impacted the numbers for the quarter gone by. The other issue is that irrespective of what the numbers are, the expectation from the stock market in the run-up to the earnings season, I think is very high. So if companies, they meet estimates, then that may lead to a decline. Now for stocks to go and stocks to react positively to the numbers, companies not only have to meet expectations, they have to beat expectations. With the exception of IT and with the exception of one or two sectors, I guess in general expectations this time are reasonably high. So can really markets where expectations are high, will they be rewarded by a fantastic quarterly performance by companies and with a positive commentary? I think the positive commentary is something which you should expect, but I don't think the numbers are really going to be that grand that we are in for earnings upgrade. And that in a sense is the tricky part now, because stocks are here and expectations are here. And earnings, they follow a pattern. They don't follow expectations. They follow real economy and the demand and supply. And on that account, because of elections, because of sluggishness in parts of economy, because of summer, all those factors in a sense could really contribute to a bit of a mild pushback in the earnings momentum.
If you like this video, then like, share and subscribe to ET Now.